Hello friends, you're watching Book Samraja. Today we're going to talk about the Little Book of Common Sense Investing, written by John C. Bogle. Do you know why most people never get rich, even after investing in the stock market? The truth is, beating the market isn't as easy as most people think. In this video, we'll show you how you can build long-term wealth by following a simple, low-cost, and disciplined investing strategy, without using any complicated tricks or high-risk strategies. If you want your money to work for you and achieve financial freedom, this video is for you. So let's get started and learn the easiest ways to understand the market and invest smartly. Chapter 1. The Truth About Investing. Have you ever wondered, if everyone in the stock market is trying to get rich, why do most people stay poor? John C. Bogle, the founder of the Vanguard Group, answered this question in his legendary book, The Little Book of Common Sense Investing. He says, the stock market is a giant distraction to the business of investing. That means people aren't really investing. They're caught up in distractions. What is real investing? Bogle explains that most people confuse investing with speculation. They jump into the stock market, constantly buying and selling in hopes of quick profits, thinking they're being smart. But in reality, they end up becoming losers in the game of the market. He says, don't look for the needle in the haystack. Just buy the haystack. Meaning, don't waste your life searching for the one perfect stock. Buy the whole market, that is, invest in an index fund. Because in the long run, the market as a whole grows. The false dream of beating the market. According to Bogle, every investor dreams of one thing, earning more than the market. But the reality is, most people actually earn less than the market. Why? Because they keep entering and exiting, buy high, sell low, and chase short-term trends. Bogle says, the more the investor trades, the less he earns. Every time you buy and sell, brokerage fees, taxes, and emotions all eat into your returns. That's why more people lose in trading than win. The real win: follow the market. Bogle's golden rule: don't try to beat the market. Just follow it. That means move with the market, not against it. Stay invested for the long term, and give your money time to grow. If you invest in the entire market through index funds, you'll earn average market returns, which are better than 90% of active investors. Example: let's say there are two friends, Amit and Rahul. Amit invests 10,000 rupees every month in an index fund that tracks the whole market. Rahul, on the other hand, picks new hot stocks every time, sometimes winning, sometimes losing, always restless. After 10 years, Amit's money compounds into 20 lakh rupees, while Rahul barely has rupee 12 to 13 lakhs with constant stress. Because Amit avoided fees, trading, timing, and emotions. And that's common sense investing. Bogle's biggest lesson. John Bogle says, the stock market returns whatever it returns. But what investors get is what they don't lose in costs. Meaning, you can't control the returns of the market, but your costs and behavior are completely in your control. So, invest in low-cost index funds, stay invested for the long term, and stop trying to beat the market. Now think about it. If beating the market is almost impossible, are you ready to change your investing strategy? Will you become a common-sense investor by adopting index funds, or will you keep dreaming about defeating the market? We'll find the answer in the next chapter, where we'll learn the real difference between investing and speculation, and why one path leads to financial freedom while the other leads to destruction. Chapter 2. Investing versus speculation. Did you know? Every year, millions of people enter the stock market dreaming of becoming rich, but only a few survive. Because they don't invest, they speculate. John C. Bogle reveals a harsh truth. Most people don't invest in the market. They bet on it, meaning most people don't invest, they gamble. What is investing? Investing means taking part in a business and benefiting from its long-term growth. When you invest in an index fund or the overall market, you become a part owner in hundreds of companies. Your money works inside those businesses, they earn profits, grow, and your wealth increases. The real goal of investing is to build money over time, not get rich quick. What is speculation? Speculation means, quote, guessing. It's short-term betting, where people think, this stock will go up, or that stock will fall, or this company's news just came out, buy or sell. Speculators constantly chase market news, rumors, and predictions. But the truth is, no one can predict the market consistently. Trying to guess the market every time is like trying to win every coin toss. Impossible. Bogle says, speculators play a game of chance, not a game of strategy. Why speculation is dangerous. Speculation gives excitement, but it eats away your money in the long run. Because 1. Every trade has brokerage and taxes. 2. Emotions like fear or greed take over decision-making. 3. The market is unpredictable in the short term. Bogle summed it up perfectly. The investor's chief problem, even his worst enemy, is likely to be himself. That means your biggest enemy isn't the market, it's you. The path of investing, calm and disciplined. Bogle says if you panic at every price drop, trade on every piece of news, you're not an investor, you're a speculator. Investing requires patience. Bogle says, time is your friend, impulse is your enemy. The longer your money stays in the market, the more it grows. But if you keep selling often, you stop your own growth. Example: two friends, Neha and Karan. Neha invested 5 lakh rupees in an index fund 10 years ago and forgot about it. Karan invested in individual stocks, buying and selling every month. After 10 years, Neha's money compounded to 20 lakh rupees, while Karan barely had rupee 9 to 10 lakhs. Because Neha invested, Karan speculated. Bogle's golden lesson: investing is ownership of productive assets. Speculation is gambling on their price changes. Investing means ownership. Speculation means gambling. Ownership builds wealth. Gambling destroys it. So now the question is, if investing is so simple and powerful, why do most people still fall into speculation? Is it greed? Impatience? Or the hypnosis of market glitter? You'll find the answer in Chapter 3, where Bogle explains how the noise of the market misleads you and how you can ignore it to build long-term wealth. Chapter 3. The real enemy of investing. John C. Bogle reveals a crucial truth. There's a big difference between a real investor and a gambler. But in today's world, most people have forgotten that difference. Bogle says, most people today are not investors, they're speculators. They buy stocks hoping it'll rise tomorrow, not because the company has a good business. This small-minded thinking, greed for quick money, and following the crowd, these are what destroy an investor. Speculation versus investing, the real difference. A speculator thinks about what will happen next week or next month. An investor thinks about where the company will be in the next 10 years. Speculation gives short-term excitement. Investing builds long-term wealth. Bogle says, the stock market is not a casino unless you make it one. Why market speculation is dangerous? Because you cannot predict the market's moves. News, rumors, and panic shake prices in the short term. But in the long term, only one thing matters: the company's actual performance. Bogle says, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Meaning, people's opinions can change, but the truth, the company's value, doesn't. Bogle's advice: if you truly want to get rich, don't try to beat the market. Adopt it. That is, invest in the entire market through index funds. When you invest in the whole market, you own small pieces of thousands of companies. Some fail, some grow massively, but overall, you benefit from the economy's growth. Example: let's say there are 5,000 companies in the market. If you invest in an index fund, you become a small owner in all 5,000 of them. Some will fail, some will soar, but overall, you share in the economy's growth. Bogle's warning: some people look rich because of speculation and market timing, but in the long run they lose. History shows no one has ever consistently beaten the market. Not traders, not fund managers, not analysts. Chapter summary. Investing means business ownership. When you invest, you become part of a company's growth story. But when you speculate, you're just playing on luck. Bogle's advice is crystal clear. Don't speculate. Invest with patience and discipline. Chapter 4. The cost matters hypothesis. The expense that eats your wealth. John C. Bogle reveals a simple yet powerful truth. You can't control the market, but you can control your costs. You can't decide whether stocks will go up or down, but you can decide how much of your profit you give away to others, fund managers, brokers. The biggest enemy of investing: fees and expenses. Bogle says, in investing, you get what you don't pay for, meaning the less you pay, the more you keep. People often think high-fee mutual funds or expert managers will earn them more, but the truth is, those fees slowly eat away your returns like termites in wood. Example: you invest 10 lakh rupees and the market gives 8% annual return. If you invest in a low-cost index fund with just 0.1% annual cost, after 30 years your money becomes about 1 crore rupees. But if you invest in a high-cost active fund with 2% annual fees, you'll end up with just 57 lakh rupees. That tiny percentage difference ate up 43 lakh rupees over 30 years. Bogle's theory: the cost matters hypothesis. Performance is uncertain, but cost is certain. Returns are unpredictable, but fees are guaranteed. You pay them whether you profit or not. So by minimizing cost, you automatically outperform most investors. Active funds versus index funds. Comparison: active fund. Index fund. Management. Expert manager picks stocks. Automatically tracks the whole market. Fees: high, 1 to 2%. Low, 0.05 to 0.2%. Risk: high, manager's mistakes. Low, follows the market. Consistency: uncertain, stable and predictable, Bogle clearly says, don't look for the needle, just buy the whole haystack. Stop wasting time searching for the perfect stock. Buy the whole market and relax. The trap of hidden costs. Investors pay not just fund fees, but also transaction costs, taxes, and turnover costs. The more the fund manager trades stocks, the more brokerage and tax, and that reduces your returns. That's why Bogle says, buy right, sit tight. Trade less, hold more. Lesson of the chapter: keep your costs under control. Don't try to beat the market. In the long run, the investor who spends less and stays patient always wins. In short, fees look small, but over time they eat millions. The more you give to others, the less you keep. That's why low-cost index funds are the smartest path. The winning formula for investing success is simple. Low cost plus long-term holding equals maximum wealth. Chapter 5. The Grand Illusion. Why beating the market is so hard. John C. Bogle exposes the biggest truth. Consistently beating the market is almost impossible. This chapter is a wake-up call for investors. Most people think they're smart enough to outsmart the market and get rich fast. But history shows only 1 to 2% of fund managers consistently outperform the market over the long term. The myth of market outperformance. Bogle says, the illusion is that you can consistently beat the market through skill. Investors believe that smart analysis, research, and timing can help them beat the market. But research shows, over 10+ years, most active fund managers fail to even match the market. Why? 1. High costs, management fees and transaction costs cut returns. 2. Market uncertainty. Short-term stock moves are unpredictable. 3. Human emotion. Fear and greed lead to poor decisions. Example: suppose there are 100 active fund managers. After 10 years, only 5 to 10 outperform the market. The remaining 90% either match it or fall behind. So consistently outperforming is an illusion. Bogle's golden advice: don't waste your time trying to find the next hot stock or the next star manager. Buy the whole market and hold. Stop chasing the perfect stock. Instead, invest in a low-cost index fund and hold it long-term. Index funds give you the market's total growth, which outperforms almost all active investors in the long run. Why the illusion persists. The media always glorifies star investors and their short-term gains. People think, if he can do it, why can't I? But those are stories of short-term luck, not skill. Bogle says, the market is a weighing machine in the long run, not a voting machine in the short run, meaning short-term prices move by emotions, but in the long term, true value prevails. So the question is, if beating the market is so difficult and illusory, are you ready to shift your focus? Will you build long-term wealth through index funds, or keep chasing short-term excitement? In the next chapter, Bogle explains how to harness the power of long-term investing, and how you can make your money work for you to achieve financial freedom. Chapter 6. The Importance of Staying the Course. The Power of Patience and Discipline. John C. Bogle shares one of the most important truths. The real secret of long-term investing success is patience and discipline. The market will always fluctuate. Prices will rise and fall. But if you react to every move, your long-term wealth growth will suffer. What does stay the course mean? Bogle says, time in the market beats timing the market. It's not about entering or exiting at the perfect time. It's about investing consistently and staying for the long run. Investors often panic sell when markets crash and overinvest when markets rise. These behaviors keep them away from long-term wealth. Understanding market volatility. The market will always be volatile. Crashes, recessions, bull runs, and bear markets, they're all normal. Short-term panic is natural, but maintaining a long-term perspective is essential. Bogle's mantra is simple: don't let emotions control your investment decisions. The power of compounding. When you invest patiently, compounding grows your money exponentially. Example: invest 1 lakh rupees at 8% annual return. 10 years right, pointing arrow 2.15 lakh rupees. 20 years right, pointing arrow 4.66 lakh rupees. 30 years right, pointing arrow 10.06 lakh rupees. Patience and consistency are your greatest wealth-building powers. Bogle's advice: 1. Make a plan and stick to it. Don't react to daily market noise. 2. Invest regularly. Small, consistent investments make a huge difference over time. 3. Ignore short-term fluctuations. The market always goes up and down, but long-term growth is inevitable. The key to investment success is not predicting the future, but accepting it and staying invested. So now the question is, if staying the course is the real secret to wealth, how will you control emotion and fear in your investment strategy? In the next chapter, Bogle explains how investor psychology and behavior affect returns, and how mental discipline can lead you toward financial freedom. Chapter 7. Investor Behavior and Psychology. John C. Bogle explains that the biggest challenge in investing lies within your own mind. The market will always be volatile, but most investors lose more money through their own behavior than through any market crash. Why investors make mistakes? According to Bogle, investors often fall into these behavioral traps. 1. Fear, selling in panic when the market falls. Example: during the 2008 financial crisis, many investors sold their funds and locked in their losses. 2. Greed, investing more during market highs or buying high-risk stocks. Example: during the dot-com bubble, people overinvested in tech stocks. 3. Herd mentality, following what everyone else is doing, buying or selling just because others are. Bogle says this usually turns out to be wrong. Real-life example: let's say Ravi and Priya both invested in the same index fund. The market crashed, right pointing arrow, Ravi panic sold. Priya held her investment. 5 years later, Ravi's money recovered only 60%. Priya's money grew by 150% because she stayed patient. Bogle explains that investor behavior ultimately determines performance. Key takeaways: 1. Ignore the market's short-term movements. 2. Stay consistent and disciplined. 3. Avoid emotional decisions. The investor's chief problem, and even his worst enemy, is likely to be himself. In other words, your biggest threat isn't the market, it's you. So the question is, if an investor's behavior decides success or failure, then how can we control our psychology to maximize our wealth? In the next chapter, Bogle will explain the simple rules for successful investing and how these rules can drastically improve your returns. Chapter 8. Simple Rules for Successful Investing. John C. Bogle explains in this chapter that investing doesn't have to be complicated. The truth is, for successful investing, following a few simple and disciplined rules is enough. Rule 1. Invest in the whole market. Stop trying to beat the market. Invest in low-cost index funds. By owning the entire market, you automatically share in its long-term growth. Don't look for the needle, buy the whole haystack. Rule 2. Keep costs low. High fees and transaction costs eat away your wealth. Always choose low-cost funds. Example: a 0.1% expense fund versus a 2% expense fund can make a difference of millions over decades. Rule 3. Stay the course. Don't panic during market fluctuations. Wealth grows through consistent investing and patience. Compounding only works when you stay invested. Rule 4. Avoid market timing. Predicting the market in the short term is almost impossible. Don't try to buy or sell at the perfect time. Long-term holding always gives better results. Rule 5. Behavioral discipline. Avoid emotional decisions. Fear and greed are your biggest enemies in the market. Discipline plus patience equals long-term success. Example: suppose you invest 1 lakh rupees in an index fund. Assume an annual return of 8%. In a low-cost fund, after 30 years, more than 10 lakh rupees. In a high-cost fund or with frequent trading, the result is drastically lower. This shows that simple rules plus consistency plus low-cost funds build ultimate wealth. So now the question is, if investing has such a simple formula, are you ready to simplify your strategies and maximize your wealth? In the next chapter, Bogle explains how to implement these rules for retirement and long-term financial security. Chapter 9. The Investor in Retirement. John C. Bogle explains in this chapter how crucial proper investing is in retirement planning. Most people think about their future, but due to wrong decisions, their money doesn't grow properly. Basic principles for retirement. 1. Start early. The earlier you start investing, the more compounding works for you. Example: if you invest 1 lakh rupees at age 25 at 8% annual return, after 30 years, it becomes about 10.06 lakh rupees. If you start at age 35, after 30 years, it's only 4.66 lakh rupees. 2. Invest regularly. Regular small investments are better than a lump sum. This is called dollar cost averaging. It smooths out market ups and downs. 3. Low-cost index funds. The most reliable way for retirement planning is investing in low-cost index funds. High-cost funds and frequent trading reduce your retirement wealth. Emotional discipline. Market falls, right pointing arrow, don't panic. Market rises, right pointing arrow, don't overinvest. For retirement wealth, consistent investing and a long-term perspective are most important. Bogle says, your success as an investor will depend more on your behavior than on your intelligence. Retirement example. Suppose at age 25 you invest 10,000 rupees per month at 8% return. After 30 years, retirement corpus equals about 1.2 crore rupees. If you start at 35, equals about 60 lakh rupees. This example clearly shows that early start plus discipline plus low-cost funds create real wealth. So the question is, if investing for retirement is so simple and powerful, will you start planning your financial future today? In the next chapter, Bogle explains how to use market history and long-term trends in retirement planning. Chapter 10. The Investor and Market History. John C. Bogle explains in this chapter that understanding market history can help you become a better long-term investor. The market has always fluctuated, ups and downs, bull and bear markets. But in the long run, the market has always shown growth. Key lessons from market history. 1. Short-term volatility is normal. Crashes, recessions, and bubbles come and go. Investors often panic sell. History shows that short-term panic losses recover in the long term. 2. Long-term growth is almost guaranteed. Over 50-plus years of S&P 500 and other major indices data show consistent long-term growth. This means, if you stay invested with patience, you can build wealth. 3. Don't try to time the market. Short-term market predictions are always unreliable. History shows that investors who try to time the market often underperform. Example: 1929 to 1932, Great Depression, the market fell 89%. But if an investor held on, by the 1950s, recovery brought significant wealth. Lesson: patience and a long-term perspective are essential. Bogle's advice: 1. Invest in index funds, own the entire market. 2. Choose low-cost funds, keep fees low. 3. Invest consistently. Regular contributions bring big results over time. 4. Stay invested during crashes. Market history shows recoveries are inevitable. The market is a weighing machine in the long run, not a voting machine in the short run. Don't follow short-term emotions. Focus on long-term value. So now the question is, if market history proves that long-term investing is the most reliable way to build wealth, are you ready to control your short-term emotions and walk the path of smart investing? In the next chapter, Bogle explains how final investing principles and practical tips can help you achieve lifelong financial security. Chapter 11. Conclusion. Final principles for investors. In this final chapter, John C. Bogle summarizes the lessons from the entire book and explains which principles one must follow to become a successful investor. Key principles. 1. Invest in the whole market. Stop trying to beat the market. Invest in low-cost index funds. 2. Keep costs low. Avoid high fees and transaction costs. Maximize compounding and long-term growth. 3. Stay the course. Don't panic during market fluctuations. Consistency and patience build wealth. 4. Avoid market timing. Short-term predictions are unreliable. Time in the market beats timing the market. 5. Behavioral discipline. Control fear and greed. Avoid emotional decisions. 6. Start early and invest regularly. Early start plus regular investments equals compounding power. Essential for retirement and long-term financial security. 7. Learn from market history. The market will always fluctuate, but long-term growth is inevitable. Past data builds perspective and patience. Bogle's final advice: the best investment strategy is the simplest. Own the market, keep costs low, stay the course, and let compounding work for you. Instead of complex strategies, hot tips, or frequent trading, simple and disciplined investing is the real key to financial success. Long-term perspective plus behavioral discipline equals lifetime wealth creation. So now the question is, if investing can be made this simple and effective, are you ready to start your financial journey smartly and with discipline? By following Bogle's principles, you can ignore short-term noise and build long-term wealth. Friends, this was the complete summary of the Little Book of Common Sense Investing. We learned how simple, low-cost, and disciplined investing can help you build wealth in the long run. Remember, instead of trying to beat the market, investing in the entire market, keeping costs low, and investing patiently and consistently is the safest and most effective approach. If you like this video, please like and share it, and subscribe to Booksome Raja for more such financial book summaries and investing tips. And yes, tell us in the comments, are you ready to start your investment journey, or have you already adopted some of these strategies? Thank you, and happy investing!